Hello and welcome back to the ROI channel, a channel that is obsessed with all things return on investment. Today we're looking at is a Porsche a better bet than a Volkswagen? We're not talking about the cars themselves, we're talking about the respective companies. So we're going to do a deep dive into the analysis, and we've got a very interesting not only valuation to look at, but an arbitrage opportunity between the two. So stick around because you might be surprised as to what you can learn. Quick recap, what we look for on this channel, what I look for every potential investment to put into the Crassus investment fund on eToro, goes through an investment formula, and here is the formula. So we're looking for companies with low debt, high margin of safety, sales growth, strong margins, free cash flow growth, and ideally share buybacks, or at least avoiding share dilution. Now, if you haven't subscribed to the YouTube channel already, I would greatly appreciate it if you could do so. If you're enjoying these analyses and if you're getting a thing or two out of it, that's great. If you could support the channel by liking, subscribing, and sharing the videos, that would be awesome. Similarly, if you haven't checked out the portfolio already on eToro, it's doing quite well relatively. So jump on the link in the description and that will take you to the page, and you can check out how the fund is doing and what we own. And if you have some funds that you'd like to invest, you can do that via the copy function. Skip the slide. There we go. So the black and whites of it, we're going to quickly work through this because we've got a lot of slides that we don't normally go through. So revenues for Porsche. I've got the revenues for Volkswagen on there. Why? Because the company structure is such that you need to understand this. So our company structure, Porsche sits up the top there, as you can see. What it is a holding company. Okay, so it is a company that holds shares in Volkswagen, and if you follow my cursor down there, you've got the Porsche family holding company that owns 53% of Volkswagen, and Volkswagen is now a huge conglomerate. They own all these particular brands here. Okay, so we're looking at the performance of Volkswagen because the performance of Porsche will be tied to that by definition. So these are the revenue numbers for Volkswagen. Then you've got the enterprise value for Porsche down below. These are the number of shares on issue for PHA3, okay, which is the ticker for Porsche that we own in the fund, and it trades on the Deutsche Extra. The company has a neutral record of share buybacks. They don't necessarily buy their own shares back, but they don't issue either. So we're not at risk at dilution. They do pay a nice dividend, so 2.75 or 2.25, depending on the price fluctuations, is generally the range within which it pays out dividends. Return on capital for Volkswagen is reasonable for a company that size, considering it's a cyclical, capital-intensive business to a degree. Market capitalization 25 billion, and the price there, if you're looking at the PHA3 ticker on the Deutsche Extra, is 81.92 euros. Porsche has a negative net debt, okay, so its enterprise value is lower than its market capitalization, and so that is always a healthy thing. We want a strong balance sheet, which makes up part of our margin of safety calculation. We're going to spend a little bit more time on this image because it's important. So get your head around this. This is at the top here, the holding company. As I said, it owns roughly 53% of Volkswagen, who own these assets, these brands, these car companies. Volkswagen, I believe, looking into the future, is actually in a better position to capitalize on the electric vehicle phase that's going on throughout the world. They have access to, think about it, they have access to all the parts, manufacturers, supply chains for all these particular brands. Whereas you look at Tesla, Tesla has Tesla, and they have an amazing PR marketing machine. They get a lot of help from government subsidies and all that jazz. But if you were to take that away, it's actually, you know, it's a pretty dicey bet. They're running on the charisma of their founder, Elon Musk, and I think that electric vehicles as a trend is something that's not going away anytime soon. And I think that Volkswagen are a better bet in terms of the diversification that they have throughout their brands. So here's the arbitrage opportunity that we're looking at straight off the bat. Okay, so before we even get into fundamental valuations, we've looked to see that the company is safe enough, it's not carrying a heap of debt, and the performance will be tied to Volkswagen. whose outlooks for the future look bright. So if PHA3 or Porsche, if their entity owns 53% of the assets in Volkswagen, is that reflected in the price? So the quick question that we can ask, purely based on trading price, is the PHA3 price 53% of the price of VOW3, which is the Volkswagen ticker that we look at? So there's Volkswagen price, 53% of that would be €102. And obviously that's a long way away from the current trading price of 81.92 for Porsche. So we've got an immediate arbitrage there, okay? Now, a quick note, you do normally expect a discount for holding companies, and particularly in the tech space, because in the tech space, you may have a holding company that owns lots of different companies, and they may have lots of different risk profiles. So you always allow a little bit of a discount. But a 10% discount, is that reasonable? I think it's reasonable given the past performance of the business, and given the types of assets that they own. The industry that they're in is not a tech industry. There's little chance of the company just completely folding and being disrupted by new technologies. In fact, they're in a position to take advantage of new technologies. So our implied share price would be around €92 per share. And even then, we have a good discount compared to the straight up price. So you've got 11% pure arbitrage already on the two companies. So if you're looking at Volkswagen, you think it's a good company to be involved in looking into the future, well, why would you buy Volkswagen when you can essentially get Volkswagen at an 11% immediate price arbitrage? You'd get it at a discount, wouldn't you? So that's why we've looked at Porsche. Here we've gone a step further, and I've broken down the enterprise values and the market capitalization. There's different reasons for the discrepancies between the two, including number of shares on issue and the debt profile between the two. The Volkswagen has a lot more debt, and they also have, those shares would have more voting rights. But for us, we're not going to buy that many shares that makes a difference essentially. So we're looking for the best deal on the assets, the best price on assets. So if you look through Volkswagen's enterprise value, there it is there. Now 53% of that would be 149.6 million. Now that is a ridiculously large discrepancy between the two, but that's taking into account all the debt. So don't forget that enterprise value is the market cap plus the net debt. So plus the debt minus the cash. If we look down here at the market cap between the two, we're looking to see, here's the market cap of Volkswagen. 53% of that would be almost a tick under 65 million. So does Porsche currently trade at 65 million? No, it doesn't. It trades at 2.6 times less than that. So you've got an immediate arbitrage in terms of the market capitalization alone. So that's obviously a huge upside. I put enterprise value in there. It's not something that I would take seriously. I'd be looking more at the price arbitrage and the arbitrage on the market caps between the two. That would be much more realistic. On that note, never know where to put my face there. Here we've got the price action of a PAH3 over Volkswagen. So the measuring one against the other as a ratio. Now I've added in this orange line here, and that's the long-term fair value has traded around 0.34 as a ratio. So if you look here, the value of PHA3 as opposed to VOW fell off a cliff. So it was ridiculously cheap. And that was around March earlier this year when we bought some. I bought some, I should say, before the fund was launched, my personal account. Now, if you look recently, you look at the discrepancy between where that long-term fair range should be, and we think that there's an opportunity to continue to buy more of the shares. So we would expect, on a mean reversion basis, that the price should start to come up around that 0.34 ratio level. So if we've got our enterprise value or market capitalization price arbitrage, and we've got an arbitrage as a ratio measuring one over the other, that we're starting to get more and more data that confirms that, or more and more data that suggests that we should be looking at Porsche as opposed to Volkswagen if we want exposure to the sector and if we want exposure to Volkswagen as a company. As always, our sort of 12 to 18 month outlook, depending on when the company has its reporting and what its fiscal calendar is. So looking towards the end of 2022, free cash flow estimates, EBITDA estimates, and earnings estimates for PHA3 and median multiples for each of those. If you add up those implied prices and equally weight them as an average, we're expecting the price to be around about 109.48 euro moving into the end of 2022. So 31st of December is the fiscal calendar of the company, and that's about a 34% upside from where we are today, which is not bad at all. Looking into our IRR calculator, I've taken the free cash flow calculations and I've said, okay, if this is the price, if you follow the cursor there, this is the price that we're paying today for the shares. That's a dollar sign, but it should be a euro, 81.92 euro. And this is our expected future cash flow streams, where we hold for 10 years and then sell at the median multiple. That's what it's projecting. And we discount it at the company's cost of capital, assuming that we can simply reinvest at that same rate. We get an IRR, okay? So internal rate of return of nearly 21%, okay? So if you're not familiar, again, it's kind of like a compounded average growth rate. This is like a compounded annualized average return rate, okay? And so if we're getting, or if we're expecting in any given decade from the broad index, a return of around 10% nominal, obviously 21% should, an implied 21% return should comfortably beat that. And that's what we're looking for. We want outsized returns, and that means we have to do some of the extra work. And that's why we go into such depth. So what I've done here again is the usual. I've run the numbers on a discounted cash flow analysis for the free cash flows of the company that's expected at a growth rate across various scenarios, earnings per share, and enterprise value to EBITDA. Here we're looking at the EBITDA, and we've got what I believe are realistic growth rates. Discount rate is the rate of return, the minimal rate of return that we will accept, and we're looking at the median multiples. And we've got a bullish case, so if things go slightly better than expected, what might that realistically look like? And obviously a bearish case where we have to put in a bit of a margin of safety to say, well, what if things don't go quite so well? And we've got our probability distribution, which there's a typo in there. I've redone that. What I did was not allow a 20% allocating to the base weighting. I allocated 70%, so I say obviously that is the most likely, and then I overweighted the bear case at twice that probability of the bull case. Okay, so the bear case was 0.2, the base case was 0.7, not 0.2, that's a typo, and the bull case was 0.1. Okay, did that for each of the aforementioned valuation inputs, and said what would the intrinsic value be. Intrinsic value in this case is looking at what is the price at which or below we can afford to buy the shares, what the max price we can afford to buy the shares at, to get our implied rate of 20% IRR. Okay, so essentially we've reversed the process. Instead of going through the cash flows and then discounting it at the company's cost of capital and saying what is that as a rate of return, we're saying what's our required rate of return, what are the expected cash flows, earnings and EBITDA scenarios in the future, and discounting back at that required rate. So we're looking at an intrinsic value of 101. I've also done one there where I took out the earnings because the earnings did seem quite a bit higher, and I believe because they have a fair few tax write-downs and depreciation that they can use. Depreciation is a non-cash cost, and it then overstated some of the earnings. So we've got 82, just a shade over 82 euro as an intrinsic value if you take the earnings metrics out. Either way, the current share price is below the intrinsic value that we would need to expect a 20% return. So we have taken some of the shares on into the portfolio, but we haven't gone and front loaded our investment. I've left a little bit in the tank that I can continue to add to this company more and more. And the reason is, if we were to get around about that 67 euro mark, we could buy the shares at 2/3 or less than the company's intrinsic value. And the intrinsic value is already very conservative because we've used such a high discount rate. So taking a leaf out of the Buffett and Munger book, if we can buy the shares for 2/3 or less than their intrinsic value, that's when we really sort of back up the truck and start to swing for the fences. The verdict, as you've guessed by now, and as I've mentioned, I am buying the stock. I have been buying it for a couple of weeks. It's been an initial position in the portfolio, and it's also been one that I own privately. As a quick recap, when you buy PHA3, it's got low debt, it's got margin of safety, it's got a sales growth record, strong margins, free cash flow growth. It doesn't have share buybacks as such, but what it does is dividend a lot of the earnings out at quite a high payout ratio, and you don't have a dilution risk. So even though the company's not buying back their shares and tearing them up, they're not issuing any more that would dilute our holdings as investors. We're currently looking at about 1.83% of our assets under management are allocated towards Porsche. That could grow in the future, particularly if it starts to get around that sort of low 70s or high 60 euro per share mark. Thank you for watching. Again, if you haven't liked and subscribed, I really appreciate you doing so to help grow the channel. If you haven't checked out the portfolio, jump on eToro via the link I'll leave in the description. And if you've got some dollars to spare and you think that you like the philosophy that we use at the Crassus Investments, then by all means feel free to copy the portfolio. And as always, disclaimer, I don't know your situation. You need to do your own due diligence. None of this is advice. You should not be lazy. You shouldn't just take anyone's word for it, particularly someone on the internet. So wish you all the best with your investing. I'm going to leave it there, and I hope you found it interesting. I look forward to going through another analysis on another company that we own in the fund.